All righty. Good morning, everyone. Although it could be a good afternoon for most of you, it's good morning for me. If you can hear me, type something in so I know we are ready to go. And I'm kind of excited because we've made a lot of changes over the last couple days. So I'm going to go through two things. My thought process is let's go through what we're doing and why. And let's help you guys understand where the opportunity is for the near future. Mary and Jim and Destin, thank you for being here. Pleasure to have you guys with us. And yes, appreciate everything. Good to see you guys. Okay, first thing we need to look at, and especially if you followed through with us on the last week and a half, we were looking at the indexes and making the understanding that, hey, what am I trying to say? The analogy, low tides sink all ships, rising tides raise all ships. And we were talking back in this range of the S&P being oversold, which coincides with the dip below the RSI right here. So our conversation was, hey, now would be a pretty good time to look to start to take put protection off. We actually had our rise on Friday is where we started with some of our put protection coming off. And really on Friday, we took off SPY puts and extra puts, I guess is the best way to say it. So with our bounce higher on Friday of last week, so we're time to cash in long put protection, right? Last Friday, we took off SPY puts, and these were the extra ones, and some extra long puts. Long put protection is actually what I should say. So let me ask this to you guys. We now have, you guys keep getting bigger and bigger. There are 24 of you here. Here's my question. Why did I nibble on taking off protection? I mean, I told you guys, hey, I think we're at a bottom. I have my day that, boom, here we are. There's that big candle. We're on our way back up. We should probably head back up to 4,000 at that time. I think it was 4,006. So why would I just nibble and take, so I guess my question is, why would I nibble and take off just a little bit? I mean, we're talking maybe 15% of the total protection. Why would I only take off a little bit and maybe not a lot? And actually, I'm sorry, our Friday, because we're Thursday, right? So I guess it was Wednesday of last week I started to nibble right there. Jeff says, we think the market's made a bottom. We're on our way up. I like, way to go, Mary, to put me on the spot. Because you said so. Mary, if the market listened to me and did things because I said so, wow, I'd be in great shape all the time, right? I'd be in really great shape all the time. I'm going to move to a better microphone. So let me go so far as to say this. I'm going to say trading in the stock market is like playing poker. When do you ever go all in? Because there are 2 times when you go all in, right? The 2 times when you go all in poker come down to when you have next to nothing left, or you are an amateur. Got to spell right. Amateur and don't know better. Those are the poker rules. You never see a pro, or I should say maybe an established pro, go all in. They understand there are times that they can be wrong, right? The pros understand there are times when they can be wrong. So we nibbled. In 100% honesty, we nibbled last week. We're like, you know what? We got to nibble. We got to nibble. We can't just take everything off. In fact, last week, I took maybe 15 to 16.66% of our protection on. 1 out of every 8 protected positions in the account had something taken off on it, right? So we then came to Monday. And we had a pretty good Monday, right? Another up day. We're seeing some Monday. That is not Monday. Monday. Today is Thursday. We had a pretty good up day on Monday. So let's see. I was texting Keeve so we could keep track of what we were doing. So Monday. Just trying to give you guys a record of my thinking. So we're on the same page and you're like, okay, here's what he's doing, here's why. Let's erase my drawings. And I'm sorry, why did I nibble on poker protection? Why did I nibble on poker protection? Why did I nibble on put protection? Because I could be wrong. So I don't do everything all at once, right? Monday. Apple puts off in the morning, usually in that first hour. And then Micron puts came off at the East Coast lunch hour. And Disney puts came off the last hour. So as I was looking at the market through the day, the first thing I took off was Apple. And I took off Apple at a pretty unique position because as we looked at Apple, it was in that 137.68 range was the low for the day. For me, I ended up taking it off closer to 139. I think it was 139.22. And my thought processes came down as you listen to Monday's trade findings, Monday's market commentary, had an upgrade, had a downgrade, had a downgrade, but 2 reiterates. No one knew what was going on Apple, myself included. But what we did know was that, at least for me, what made my decision, T-Mobile has an 8 to 10 week an 8 to 10 week lead time on the iPhone 14 Pro. In my mind, I'm thinking, okay, if one of the biggest groups has that lead time, and Verizon and AT&T are giving away iPhone 14s, maybe there's quite a bit of demand for it. I look pretty good right now. I've had about what, $6 to the upside, $6.50 to the upside with outputs on Apple. We booked 160s, 157.50s, 149s. I mean, we made money on Apple on the way down pretty convincingly. But my thought process on Apple, first thing, usually after that first hour, the market close or market open, excuse me, boom, I took off Apple. The East Coast lunch hour for me happens between 10:30 and 11:30. That's 12:30 to 1:30 Eastern Standard Time. There's a drop in market volume. There's usually a little pullback. I call it the East Coast lunch hour. For me, I took a look at that East Coast lunch hour and I was like, okay, technology is coming back. Technology is coming back, and I took off Micron puts, which again, 52.50 at 54. I've made about, well, that's Thursday. Actually, it was Monday. Probably closer to 51. I've had like a 5% run up on Micron without puts on. Nothing more than, hey, they make semiconductors. Well, do I wish I got it off at 48.45? Yeah. But at 51 on $60 puts, I feel pretty good. Looking at this chart, where am I going to get puts back on Micron? Where am I most likely going to get puts back on Micron? It's glaring. It's kind of staring you right in the face there. Now, okay, so just because we have a bit of a down day today, 1.1%, 60 cents there, just because it's a down day, just because it looks like it's turning on the RSI, does not mean I'm going to go throw puts on right now. I'm looking at something else. That might justify it for you. That does not justify it for me, though. What might be what I'm looking at my next step to put puts back on Micron? I'm going to let you sit there and look at it. I don't want to really give it away per se, right? But when am I going to take puts off Micron? If it takes out the low of yesterday, you know what? That is a pretty good comment there. That is systematic trading, right? Could be. And the low of yesterday also coincides with the pivot point at 52.45. Jeff, that's great analysis. That's not what I'm doing, but that would be a great justification of when to add it back on. Get some 52.50s back on. There's a pivot point. It would take out the low from yesterday. That all makes sense. In fact, that's spot on. I was looking more at the 50-day simple moving average at 57.03. So around 56, my spider senses get tingly, right? And at 56, I'm looking and I'm spending more time throughout the day checking on Micron because I'd love to stick on a 57.50 if it gets up to 57. I'd love to stick on a 55 if it hits 56 and starts to come down. Jeff, your analysis is just as well. For me, because we've been so beaten up in the market, I think we have a buying opportunity. I think the market's on sale. I know most people don't think that way, but that's my thought process in that regard. And then to finish up the day, Disney. I got out in Disney on Monday. And this one was kind of a no-brainer. Nothing like getting out of Disney, kind of nailing a bottom for a day, getting out at 95 when the low is 94.26. Yes, I knew we had some 92s. I know we had some 90. For me, Disney is just undervalued. I mean, Disney should be 196 to 220 with all their movies. Their movies are coming out. They're gonna get better returns and better earnings because their cash cow is their movies. They're raising prices, for crying out loud. They're raising prices and doing pretty darn good. I don't know how to say it other than I think Disney is a screaming buy. It is a screaming buy. I think we should be in it, and I think it has huge, astronomical upside potential is what I'm going to tell you. So for Disney, it was a no-brainer to buy back in. All right. That was my Tuesday or my Monday taking stuff off. Tuesday, follow through. For crying out loud, we had follow through like there was no tomorrow. I had no understanding of what was going on, right? I'm sitting here going, for crying out loud, Tuesday we have follow through. We might get that 10% in 2 or 3 days. So Tuesday I sat here and I thought, okay, time to take off some more. I'm not going to take everything off. Again, professionals, just like in poker, we just don't do that, right? We don't just take everything off all at once because we could be wrong. We could be wrong. We don't go 100% all in. Just like poker, those you only go all in when you have next to nothing left. You're an amateur and you don't know better. That's my polite way of trying to say you're an idiot, right? So we didn't take everything off. We nibbled on Friday. We nibbled on Monday. On Tuesday, and I'm going back through my text to Kiev. On Tuesday, we took, boy, I wrote a lot to him. On Tuesday, early in the morning, because we had follow through, Ford, Baidu, Boeing, puts came off, it looks like, from what I have here. And probably Bank of America. I'm going to go do a quick check. But here, the first hour, the lunch hour, I decided, you know what? We're getting follow through. We have got to take some stuff off. And in doing so, kind of another no-brainer, right? Kind of another one of those, hey, no-brainers. Ford got an upgrade. And Ford was down. Ford was down at like 1150. It was even 11. I don't know why. Maybe Ford I did on Monday too. I'm not sure. But Ford seemed to be down $11 at that low that coincided with 1103. It was closer to $11.40. So we took Ford off. We took Ford off and we thought, hey, We just got to be smart. There's an opportunity for a big bounce on Ford. Then it had an upgrade. Give me one quick second here. Thank you. Sorry about that. So Ford was just running in those lows of June and July. We booked great money on Ford with $15 puts, taking them off in that 1140-ish range, and off we came for Ford, right? Pretty simple to take care of Ford there. Baidu. For the most part, we've had two sets of puts on from 160, I guess 157.50 is where we were at. So in the money puts all the way down. It made our September. It made it so we didn't lose our shorts in September. And I think we took the 157s off. Boy, I think we was way down here at 120. And then we took 135s off, or 140s off actually, down here in the 120s as well, just later on. But it was pretty easy for us to say, there it is. The lows on Tuesday, which are right there, we took off our second set of Baidu, and we're running on Tuesday Baidu now with no puts. Kevin, how could you do that? How could you now have another position that's 15% of your portfolio? How could you run China without puts? Well, we ran it double puts through the falls of September, and we were sitting on over $660,000 of put profits. So we took off all of our puts on Tuesday on Baidu. And no, we did not hit the 115.16. We were close. It was 120. 120 and a little bit of change. Kind of got on a low on a day and it kept going up. Yes, we have Baidu with zero protection, but we made easily $1.60 on the way down through September for every dollar that Baidu lost. Boeing's the hard one, right? Took puts off of Boeing Tuesday. Difficult one, right? Tuesday took it off. We were somewhere in that 130. Went up to 135. We look smart. Today back down to 131.21 and we're down 90 cents. Thought process here. Boeing breaks 130. Puts are going back on. In fact, yesterday scared us enough that yes, puts are back on Boeing in a higher strike price. And then last one on Tuesday, we took off Ford, we took off Baidu, we took off Boeing, we took off Bank of America. $35 puts we took off on Bank of America. First hour yesterday. It probably was at one, it probably is exactly where it's trading at right now, 31.60, 31.50. We captured 10% profit on $35 long puts on Bank of America. And probably $31 is going to be our line in the sand to put Bank of America puts back on. So for us, it was over a 3-day process that we took off about 75% of puts. Today, if we were to look at our positions, and Jeff, I saw your question, I'll go back in there. Today, I believe we still have JP Morgan puts on, Under Armour puts on that are way in the money. Let me take a quick peek through my phone here. I'm going to go through our list. And Keeve, if you can help me out. No Apple, Boom, we put back on. Nothing on Baidu, nothing on Disney, although Disney puts her back on. No Coke. Lockheed Martin still has puts on. JP Morgan still has puts on. Nothing on Micron. Under Armour has puts on. Nothing on Visa. Verizon has puts on. So in essence, what we've done, and we should have SPY puts on. So it's kind of unique. At least I think it's unique, and I wish we had this not in the middle. Let's go back to the home and let's get this over. Over a 3-day period of time, we took off roughly 75% of the protections in the portfolios. And we're looking at everything that we're looking at, we're doing it on a, sorry about that, guys. We're doing it on a one-to-one stock basis. We're not looking at it as a portfolio in general or just certain amounts. We are truly doing our put protection, and again, instead of just taking it all off at once, we nibbled on Friday of last week, we nibbled on Monday, we nibbled on Tuesday. Friday, not a whole lot of trust going through a weekend. We did know it was the end of the quarter, so new money should be buying in Monday, Tuesday. But Friday, we took off about, 16.6%. Monday, Apple puts came off, probably took off about 35% of protection because Apple's such a large position, Disney's such a large position. Tuesday, another 25% of the portfolio values had their put protection taken off. So in essence, we're kind of doing this in a systematic way for when we have our puts coming off and coming on. What we haven't done, and it's really easy to say, we currently are not ready to buy more shares of stock. My belief this year, if we take a look again at the S&P 500, right? If we look at the S&P 500, I think we're going to make new lows. We could nibble on some shares like Under Armour, Bank of America, Ford, but we're testing our lows. We are creating a double bottom. The elections will mean a lot, and we need more representatives like today to say, hey, we need one more rate hike and we need to sit back. I forgot who said it, but one of the chairs, the Fed chairs today, said we probably need one more rate hike, a good one, another 100 basis points, and then we need a pause to sit and view the market. That will be a catalyst for our market. It would not surprise, and that doesn't come till December, by the way. It's December like 1st and 2nd is the next Fed rate hike. They do have a November one, but they usually do not raise rates without being able to have without being able to have a press conference. They also usually don't raise rates right before an election. So my expectation is no rate hike in November, and we just have to go through some pretty dismal earnings, most likely. Jeff asked a couple questions. when it comes to buying puts, we're usually out through the event and at least 4 to 6 weeks. So if I was buying for an earnings event, I'm 6 to 8 weeks, usually 8 weeks out in time, Jeff. And for buying puts or protection, I'm just going to say for the most part, at the money, put purchases, and it's any option purchases, at the money put purchases are the best bang for the buck. And that really comes down to, you don't want to overpay for protection by buying in the money. You don't want to underpay protection from buying out of the money. It just doesn't make sense. If it's put protection on stock ownership, it doesn't make sense to buy $2 or $3 out of the money, $5 out of the money, 2 strike prices on Disney. It's like, hey, I'm willing to lose the first $5 down on Disney, which is 5%, because you want to be cheap, right? I'm going to be cheap. I'm going to get the cheap rate insurance. At the same time, you don't want to overpay for Disney and buy a strike price out of the money, because if it bounces up, you know, that first $2.50 or $5 to the upside gets eaten up immediately in volatility crush and in the raise of the stock price. So really, you've got to be smart. At the money is usually the best bang for the buck, where you're not overpaying or underpaying. This year, for the most part, though, I have been slightly in the money. If Disney's at, you know, Disney's at $94.50, I'd be buying puts at 95. I've been trying to take advantage of buying that protection with a little delta higher than, you know, 50% or 55 cents on the dollar. But I'm not going 90 cents in the dollar, because it just kills you on the way up. Does that make sense, Jeff? Would you please type something in to make sure we're on the same page there and I got your questions answered? So there is the short answer on what we've been doing and why. We're treating the stock market like poker. We're not going all in on put protection. A professional will tell you going all in on put protection is not smart. The only time you go all in poker, same thing with the stock market, is when you have nothing left and it's a Hail Mary shot in the dark, or you're an amateur and you're just being stupid, right? That's my polite way of saying you don't know better. You're an amateur and you're just being stupid. We're like, oh, I'm going all in. You only need that once to burn you and watch a portfolio evaporate by 50% in 30 days to learn. Not smart. No muy bueno. So that's what we're doing. That's where we're at. With that said, yesterday did scare us. Disney broke below 100, so Disney put protection is back on. Boeing put protection is back on. And because we have some smaller accounts, even though they still have Under Armour puts on, that they still have Bank of America and Ford without puts, we added some SPY protection back on to accounts, and really does a huge help for the smaller accounts versus the bigger accounts. So that's what we're trying to do today. We're talking trading. We're talking about what we've done and why. I'm trying to show you the charts and the reasons why. Are there any questions you guys have for me that I can answer you on what Keith and I have done over the last week when it comes to protecting our portfolios and why we're doing what we're doing? Going once. Going twice. Do you ever use SPY puts versus a stock? Very interesting. No, we don't. For me, Jeff, I learned in 2008 when we were breaking huge levels of support, the index puts seemed to move significantly slower than stock puts. And not only that, but I also learned you can double or triple up on puts on a stock and make $2 down for every $1 it's falling when the bottom falls out. We've had a pretty orderly, this has been what I would say the most orderly 25% decline I've ever seen in our stock market. And really, I truly did some trading in the 90s, but my trading record usually starts at around 99, 2000. That's when I truly started spending the time and learning and investing. So I missed the 90, 93, 94, 96 drops. Got the 99, the 2000, the 2003, 2008, 2010, last, 2020 stealth drop. Some of those were not so orderly as we've seen this year. This year has been an orderly movement down. And I'm more comfortable personally with individual puts on stocks and be having the chance to double up as they break support levels. The SPY puts are really for the drops in our market like we had in September, where I've got to help out my smaller accounts that are less than $100,000 where the stock market is falling and we need to make something extra on the way down. But I would never do a SPY put to protect a stock. It moves too slow. It's an unequal arbitrage. It's apples to oranges. It's not apples to apples. Great question. Kevin, yesterday you were wrong again. So Lance, yesterday, yes, Boeing, the stock market, and Disney came back. Today, I'm not wrong. So again, it comes back down to what's the difference between a professional investor and a retail trader, or dumb money versus smart money. And the only difference there is time horizon. I'm not a day trader. I'm never putting positions on for a day, Lance. So with all due respect, once again, I'm never wrong on a day. I'm making my best educated decision, and my time horizon is 6 to 8 weeks out for the puts. It's 3 to 6 months out looking at our stock market. It's 6 to a year out looking at stock. And am I going to pick tops and bottoms? Of course not. So the expectation is not there. And Lance, I've had Alan come the last little while that's kind of said the same thing. With all due respect to education, and I love safe option strategies. I think Jeffrey Dunyan does an amazing job. You'll do very well with options animal and Greg Jensen. You'll do pretty good if you think you're learning and you want to follow guerrilla trades. Those are 3 educations with some integrity, but most don't have integrity. And I giggle at the crap that's sent out. I giggle at someone that says they're going to give you a trade each week. They're idiots. They're not smart. Yes, they may have integrity, but it's not smart to be doing that. There are times you shouldn't be trading in the stock market. And those times are when you're looking at what's going on. And if you don't have a clear trend direction, which sometimes in the market takes 2 to 4 weeks to see it in the first place, you're guessing, you're gambling. It's not smart. What percent of puts do you take off each day, like Monday, Tuesday? So I'm usually protecting 1 to 1. So if I'm taking puts off, it's leaving stocks with just the stock positions off. So I don't take a percentage of puts off of the stocks. As I'm saying, I took off Ford. It's all the Ford for the 190,000 shares we had. All of Ford puts came off. For Baidu and the 21,000 shares, all the puts came off. For Bank of America and the 15,000, that's been Bank of America, the 37,000 shares, all the puts came off. Boeing for the 15,000 or 1,500, I can't remember which one I have there. All the puts came off. Apple, 21,000 shares of Apple, all the puts came off. They all come off. I don't leave some puts on. The percentages were percentage of protection on the portfolio. Last Friday, before I started taking things off, we were 100% protected. There's puts on every position, and there were some spider puts on. So last Friday, I took off about 16% of the protection on the portfolio. Some positions had extra puts on, so that came off. On Monday, about 35, 36% of the protection came off, and off it was. Tuesday, another 25% came off. It's like we've got portfolios roughly 75% is free and running bullish, and 25 have protection on. What do you think about protecting for Russia nuke use? Not needed or some? Jeff, all the way back in March, April, you heard me talk about Russia-Ukraine war and basically say it's a non-issue for the U.S. It's a non-issue for the U.S. It is it's just not important. It doesn't affect our stock market. Ukraine is like 1.3% of the world economy. It's a non-issue for us. Well, Kevin, if they use nukes, we go to war. I get it. I'm not saying it wasn't scary, but right now, Russia and Ukraine affect Europe much more than they affect us. For us right now, it's a non-issue. So I have not protected portfolios at any time this year for a Russian-Ukraine war. I have protected portfolios that coincide with that on technical indicators on the indexes to go bearish. But again, I have not in any way, shape, or form protected individual positions or portfolios for anything related to Russia or Ukraine. Mathematically, it was a non-issue. And Jim, thank you very much. And Lance, thank you for your questions. Yes, I appreciate your questions. No, they don't make me mad whatsoever. And if my tone of voice comes across as a matter of fact or angry or frustrated, as baggage from a previous phone call I got on before I came on here, it's never directly related to you in any way, shape, or form. It's years of baggage of dealing with, well, this guy's got 100% return. It's like, really? Let's open up a portfolio. Oh, well, he said he can't share it. Well, let's see if he'll talk with me and the Securities and Exchange Commission, where he can learn as an educator, yes, you're supposed to open up and show a real portfolio, not just paper trade and think that you're doing it for reals. And that's when they all of a sudden, well, yeah, I'm not doing every trade for reals. And they find out the real answer is that they're full of crap. So I do hold some baggage or some resentment at being compared to paper trading portfolios when I've got my own money in, I've got real people's money in. There's nothing that I do that's paper traded at all. This is all live. We're off to go. My positions are the same positions you guys are in. Keeve, yes, Keeve as well. Keeve also, in fact, don't let Keeve know, but I'm kind of jealous. Keeve actually has more money in the market than I do. And so, yes, you could even say Keeve has more interest in what's going on, what's happening than I do, because he's got a bigger dollar figure in than I do. But I've also got 3 times as many kids as he does, so it is what it is. All right, hey, I don't see other questions coming through. I hope this was helpful. If anything today, I hope this is trying to see inside of the head of someone that's trading tens of millions of dollars, that you can understand the process of how we're trading your money, and that you can see what we saw going back to last Monday and last Thursday. We expected a bounce. We expected a bounce a week and a half ago because we were down around that lows, but we're not expecting that bounce on the S&P to get above the 50-day simple moving average. So 4,000, it was 4,006. We were calling 4,000. It's now 3,995. We're going to get up to that point and all protections going back on because we're expecting our next leg down. Kevin, what's our next leg down? Our next leg down are the Fed sticking to their guns and their comments. The next leg down is earnings that should look pretty piss poor through the summer months that we just had. Really, gridlock in the election is the next catalyst for our market to go higher and to get through 50-day simple moving averages, 200-day simple moving averages. FYI, no one trades off a 100-day simple moving average. If you hear someone talking about a 100-day simple moving average, it's because they're on TV and they think it's important. But in real life, no one trades a 100-day simple moving average. It's just not something that any big money uses. Little retail guys, or again, people that don't know any better, talk about a 100-day moving average. So that is why you don't ever hear me mention it, because it's a non-issue. It's fluff. It's garbage. It's not important. So because it's not important, we've never looked at a 100-day simple moving average. Good question there, Lance. All right, guys. Hey, have a great one. Pleasure seeing you guys here today. Look forward to seeing you next Monday evening. And guys, have a great day. Bye-bye.